first thing to know is that there are two kinds of options you can buy: call options and put options. Buy a call if you like a stock and think it'll go up.
We like the stock.
Buy a put if you think a stock will go down. An easy way to remember this? You call people you like. But dying cars go put. Now let's look at some call options to understand how they work.
Ooh, look at this here we have here. We have some calls. Get your Tesla calls here. We got a $1,200 call just expiring just 2 years from now for the low price of $80.
With a call option, you basically pay a reservation fee to reserve the right to buy stock for a certain price. You can exercise your right to buy the stock at that price anytime from now until the expiration. You'll see all this info on your favorite stock trading app. You choose how long your reservation will last, as well as the buy price you want to reserve, also known as the strike. The reservation fee or options price / premium varies depending on those choices. I'll take that.
Ah, wonderful. Here you go.
Fingers crossed. If the underlying stock never reaches your reserved price, your reservation expires worthless. But you'll only lose the reservation fee you paid up front. You can walk away without actually having to buy the stock at the price you reserved. But if the price of the stock exceeds my reserved price, that means I get to buy the stock at a discount. I made some gains! So, buying call options can be pretty sweet if you think the stock will go up. The potential loss is capped while the upside is theoretically unlimited.
Pro tip! Hey little dudes, instead of exercising your reservation, it's almost always better to just sell the option back to the market before it expires. Let's take a look at a real example. On November 16th, Tesla stock was $408. A call with a 610 strike expiring February cost $981, and a 700 strike cost $549. Fast forward though to December 21st, the stock rose to $650. That's a 59% gain, bro. Solid. But wait, something even more ludicrous just happened. Check out the options. The 610 strike had a 905% gain, and the 700 strike had a 952% gain. That's pretty good gains, bro. So even if Tesla didn't hit the 700 strike, you still could have made some sick gains if you sold in December before the expiration. Dude.
Put options are very similar, but instead of reserving the right to buy the stock at a certain price, you're reserving the right to sell the stock at a certain price. So this is good when you think the stock will go down.
Get your puts here, Tesla puts. We got a $400 put expiring 2 years from now for a reservation fee of just $80.
So if Tesla stock never goes near my reserve sell price of $400, my strike, my put option just expires worthless, but I'll only lose the $80 reservation fee I paid up front. But if Tesla's stock price goes below $400, I can buy the stock and sell it at my higher strike of $400 for a gain. Yeah. So that's it. Options explained. Happy trading.
Oh, just look over there. Look over there just beyond the ridge. I can't believe what I'm seeing. Look at it. It's so wonderful and beautiful. It is a subscribe button.